Hello, I always look forward to these updates and will try to provide some input on the market, talk about how our funds have performed since last time, and share some thoughts about the future. Regarding the webinar we held last time in December, I showed a graph that looked like this, where the light blue line represents the 7 major tech stocks in the US, the so-called Mag 7, and the dark blue line shows the performance of the global MSCI All Country World Index. I definitely had fear heights, both during that webinar and SKAGEN's New Year's conference in January, when I made what seemed to me an obvious prediction that this wouldn't last. And it didn't. It came to a halt on February 19 when the market hit a new high. During our last webinar, I highlighted Europe, small caps, and emerging markets and value companies as areas of opportunity. It has been a very short period to judge, but all except small caps, which continue to face economic and sentiment challenges, have outperformed since then. The market has broadened and investors have started to rotate away from highly priced companies, especially US tech stocks, towards more attractively valued parts of the market. Now, Europe has outperformed the US by 11 percentage points year to date, where US has been weighed down by Mag 7 stocks, which are down 14% year to date. Emerging markets has beaten developed markets by 6 percentage points, and value has outperformed growth by 9 percentage points. Global small caps and large caps are both slightly underwater. Now let's move on to the fund performance. I must remind you again that this is a very short time period with less than 3 months to go, or in all. So absolute returns have been mixed, with SKAGEN Global, SKAGEN Focus, and SKAGEN M2 have had negative returns as of last Friday, while SKAGEN Kontiki and SKAGEN Växt have both posted positive returns. It is encouraging that all the funds are ahead of their respective benchmarks so far this year, depicted here in the light peach bars. SKAGEN Global's positive relative return is driven by the stock exchanges TMX in Canada and ICE, or International Continental Exchange, in New York. These are two well-run companies benefiting from increased trading activity and expansion of their platforms. On the negative side, we find Alphabet, or Google, which has fallen along with the rest of the US tech sector. SKAGEN Kontiki, which is doing well in both absolute and relative terms, has seen strong performance, primarily driven by its investment in Alibaba, but also by Samsung, a long-time holding. There have been a few losers in the fund, but the weakest contributors lost only a fraction of what Alibaba gained, highlighting the continued good stock picking by the team. Like SKAGEN Kontiki, Alibaba also contributed to the outperformance of SKAGEN Växt, which has had positive absolute and relative returns in 2025. Bonheur was the weakest contributor so far, but otherwise there were no major detractors. Now, SKAGEN Focus, which is mainly invests in smaller companies, tends to be a bit more volatile. The fund is performing well ahead of its benchmark index, driven by holdings mostly in raw materials, such as cement, steel, and bricks. The best contributor is the steel company Acerinox, which is listed in Spain, but has 80% of its production in the United States, thereby avoiding tariffs on its steel in the US. On the weaker side, we have a nickel producer in Indonesia and a methanol producer in the US. Last but not least, SKAGEN M2, our global real estate fund, had two main detractors year to date: the tech-related real estate segments, Digital Bridge and Equinox. This has been more than offset by strong performance elsewhere, such as the European logistics operator CTP and the US healthcare company Brookdale, which is an exciting new addition to the fund. Now let's take a step back and look at the bigger picture. The OECD recently downgraded its growth outlook for the global economy. According to the latest Bank of America Global Fund Manager survey, March saw the second largest drop in global growth expectations on record. It also showed the biggest monthly drop in US equity allocation on record, along with the largest decline in investor sentiment since the onset of COVID. What is happening in the US and global markets? Donald Trump is, for the most part, doing exactly what he said he would during the election campaign, if not even more. So, what did he say and where are we? Let's go through the list. The geopolitical landscape has certainly changed, and no one really knows with any certainty what the long term picture will look like. Tariffs, on again, off again, hugely concerning for the market and the corporations. The next announcement from the Trump administration are expected on April 2nd, i.e., next week. Now, taxes, nothing has really happened on the tax front so far, but Trump is still advocating for tax cuts and aims to extend the cuts from his first term in the White House. And on the regulation side, with the Department of Government Efficiency, or DOGE, cutting funding across multiple departments, deregulation is happening at a record speed, from the environment departments to healthcare to withdrawing support for international aid and institutions and so forth. The immigration issues are still ramping up. Rumor has it that Trump is unhappy about the current pace of deportation. Now, in addition to these themes that we mentioned at our last webinar, I would like to add the rule of law. Trump is certainly challenging this, the international world order, and maybe even democracy. And what does this uncertainty mean for companies? Just imagine you're a business owner faced with the decision to build a new factory that will take 5 years to complete and require a significant investment. With unstable and unpredictable policy decisions for the business community, you'd think twice, or at the very least, delay making such a major decision. It's the same challenge businesses face when trying to adjust the prices of the goods they sell in a tariff regime that is on again, off again, or planning for wage cuts. How is a construction company, or a farmer for that matter, supposed to budget for wages if half their workforce might suddenly be deported to South America? Now, although we may despair over some of the uncertainties, as investors, we have to stay focused, knowing that companies will adapt to most changes. The world will continue to be specialized. Trading patterns may change a little over time. Currencies will adjust, but trade will remain global. Now, if you are like me and stop by a local coffee shop on your way to work, at least 10-15 countries have been involved in making that cup of coffee. Now, let's go through the list. We have the beans come from 9 major coffee producing countries across Africa and South America. Processing of the beans is mainly done in Germany, Switzerland, Holland, and the United States. The milk comes from the large milk producing countries in New Zealand, Australia, and America. The sugar, a lot of it comes from India and Thailand, and the cup and lid comes from China. And then, of course, you have the machinery to produce the coffee. That they are mainly made in Italy, Germany, and Switzerland. And if you have flavor in your coffee, that will come from Madagascar in India. And then put it all together, you have to transport everything across the globe, and you have to go through the Suez Canal or the Emirates or Singapore or even in Holland in Europe. So I do not think that globalization is on its way down. I think most of the things we have in our daily lives come from global trade, and I will certainly continue to drink my coffee throughout 2025. Now, living with uncertainty is nothing new for a portfolio manager. Those who have followed SKAGEN over the past decades know that we are long-term investors. We don't follow the latest fad or jump on bandwagons. Instead, we try to stay focused on the long-term picture and understand where to look for undervalued quality companies. And I think it's precisely in turbulent times like these that attractive opportunities can often be found. They may appear suddenly, like during the ash cloud incident in 2010 or COVID in 2020. Normally, however, they appear when you are analyzing the market diligently for overlooked and mispriced opportunities. SKAGEN is a value investor and always on the lookout for good deals. Although the market overall is priced above its historic average, this is largely skewed by the US, which still represents almost 3/4 of MSCI World Index. Elsewhere, on the right-hand side of this graph, there are pockets of opportunity in areas like Europe and emerging markets, which are trading at or below historic averages. And you can see this very well on the next slide, because these are also the markets that continue to trade at a steep discount to the US versus historic averages. Our funds have significant exposure to Europe and emerging markets, and the portfolio managers are navigating opportunities on many fronts, including defense spending, Ukraine, and even artificial intelligence. We will always, however, be looking to have a broad, diverse portfolios. Now, looking ahead, geopolitical tensions have, of course, been around for a long time, but what's new is that the West is now far more directly affected than in the past. It is important to look through the noise, avoid acting on impulses based on social media, especially Twitter feeds, or making decisions based on news updates, which are, as we know, tend to be led by negative stories. The best way to navigate volatility is by owning a well-diversified portfolio and get advice if you are uncertain. Remember, it's all about staying in the market. It's about time in the market, not timing in the market. History shows that investors who stay invested in the market in the long run will reap rewards that make the turmoil worthwhile. And if you think about it, have we ever really had calm markets? Like my good colleague Anders likes to point out, would you have invested in December 2019 in the stock market if you had known about the attack on the Capitol, about the outbreak of COVID, about the Russian invasion of Ukraine, and subsequent ongoing wars in Europe and Middle East? And yet again, the market has doubled since that time. Although it's easy to paint a dire picture of the financial environment, I always find that the markets finds its way. Corrections are normal, healthy even, and if markets do fall further into bear territory, defined as a drop of 20% or more from the recent highs, they tend to recover losses relatively quickly, particularly when underlying economic conditions are healthy as they are at present. Now, this brings me to another final reason for optimism, as you can see from this graph. Despite the geopolitical uncertainty, expectations are for company earnings to grow across the board in 2025, which is an important component of share price performance. This is depicted by the green bars on this slide. This also makes sense. Corporates adjust, new markets are found, and capitalism continues to thrive. Earnings are also predicted to broaden compared to 2024, the gray bars on this graph, particularly in the US, where the very large gap in earnings growth between the Magnificent Seven and the rest of the market is expected to shrink in 2025. Again, this is healthy. Despite the noise created by Trump's social media account, the world continues and SKAGEN finds opportunities where others are not looking. Emerging markets, small caps, value. We will continue to stick to our philosophy and investment processes, and I look forward to keeping you updated on our progress throughout the year.